So in the last two videos, we solved some examples related to full year policy and monthly basis policy for both of the methods, that is straight line method and for reducing balance method as well. Now in this video, we will be solving again an example, but this time it is a bit complex example. Right now, why is that a complex example? This is because first of all, the year end is different in this example, right? Previously the year end used to be 31st December, which is a lot simpler, right, when solving an example for a different year end. So in this example we will be learning about that as well. Now secondly, there are multiple assets involved in this example, right? Previously there used to be just one asset, and for that one asset we have to calculate depreciation for several years. But in this example there is more than one asset involved, right? And lastly, the method that we will be following in this example is reducing balance method, and that too for monthly basis policy, which is a bit trickier than if we are following straight line method, and that too with full year policy. So now let's begin. The example says a business prepares its financial statements at 30th September each year, right? So what is the year end? In this example we have the year end at 30th September, right? So if this is the year end, 30th September is the year end, this means that the year start would be 1st of October. After September, October comes, so that is why the year start is 1st October every year and year end is 30th September. So this is how you establish a timeline. For 31st December of year end, the timeline used to be from 1st January till 31st of December, right? But now the timeline is from 1st October till 30th September. Okay, let's move forward. It also says that its non-current assets consisted of 4 items, right? 4 items, details of which are mentioned below. So we have the purchase dates for all of these assets. We have the names, machinery A, B, C and D, and we have the cost price. Okay. Now the policy. The policy is to charge depreciation for each month of ownership. This means that full year or monthly basis policy, using reducing balance method and at the rate of 30%. Right. So we have the policy, we have the rate, we have the details of the assets, and most importantly we have the timeline. Now the requirement is to calculate depreciation expense for the year ended 30th September 2021. Right. So is it possible that I directly calculate depreciation for the year in question, that is 30th September 2021? Can I do this? No. And why is that so? This is because I am following the reducing balance method, and we know that on using reducing balance method we calculate depreciation on the net book value. So if I want to calculate depreciation on net book value, I have to start my calculation for all of these assets from their year of purchase, right? So that I arrive at net book value for the last year, and then I calculate depreciation for the current year ended 30th September 2021, right? Now before moving towards the calculations, let's first establish the timeline so that it gets easier for us to charge depreciation on all of these assets, right? We know that all of these are not purchased in the same year, right? These are being purchased in different years, so we have to first establish the timeline like this, right? So that we know that for how many months we'll be charging depreciation on all of these assets. So first asset that is being purchased, that is machinery A, is being purchased on 1st of January 2018. Right. So this means that in which year will this date fall? It will fall for, first of all, the year end would be 30th September 2018, right? 1st January 2018 will fall in the year ended 30th September 2018. This means that the year start would be 1st of October 2017. Now this is the first year, right? Now it gets very easier that the next year start would be 1st of October 2018, right? That year end was 30th September 2018, next year would start on the next date, that is 1st of October 2018, and the year end would be 30th September 2019 this time. Similarly, third year would begin on 1st October 2019 and end on 30th September 2020, right? And fourth year 1st October 2020 and it will end on 30th September 2021. And this is the requirement that we have to charge depreciation for the year ended 30th September 2021. So we have 4 years of time. Now let's begin. So we'll be following the vertical format in order to calculate depreciation on all of these separate assets, right? Because we'll be charging it on the net book value, so that it will be easier for you, because you don't have to then calculate the net book value again and again for each year. So the first asset, that is machinery A, is being purchased on 1st January 2018 and at a cost of 2400. So this means that this is which year? This is the year ended 30th September 2018, right? So the first year ended is 2018. Now what is the cost of this asset? The cost is 2400, right? And what is the policy? The policy is to charge depreciation at the rate of 30%. So 2400 multiplied by 30%. But is that it? No. I know that I am following the monthly basis policy of depreciation. So now I have to count the number of months for which the asset was there in the year ended 2018. So since this is being purchased on 1st of January, right? So this means that from January till September you count the months, and the months would be 9 months, right? So in the year of purchase, this asset was there in the business for 9 months. So for 9 months I'll be charging depreciation in its year of purchase, and that is by multiplying it with 9 and then dividing it with 12 months, right? So this means that my depreciation in the year of purchase will be 540, right? Are we purchasing any other asset in the same year, for the year ended 30th September 2018? No, because now this is the year has changed, it is 2019, so this will fall in the next year. So that's it. Let's calculate its net book value, and that would be 1860. Now let's move to the next year, and that year end would be 2019. Okay, now what is happening in 2019? Are we purchasing any other asset? We are purchasing on 1st of May 2019. This means that this asset will remain in the business from May till September 2019. May 2019 till September 2019, right? So for how many months? For 5 months, right? This was for 9 months, this is for 5 months. Now as you can see that there is a similar year end, that is 2019, for the next asset as well, that is machinery C. But do you think that this will fall in the same year as machinery B? No. Why is that so? Because this we are purchasing on 1st of October 2019. So let's just check our timelines, that 1st of October 2019, this year will end on 30th September 2020, right? Now we are calculating depreciation right now for the year ended 2019. We have calculated for 2018. Now we are standing at the year end of 30th September 2019. This asset is being purchased on the first date, but for the next year, right? Now the calendar year is same, that is 2019, but the financial year is different, right? So make sure that you do make these timelines, so that you don't end up getting wrong figures for depreciation, right? So this we'll be doing the calculation for this year in third year. Right now we are standing on May 1st 2019 for the year ended 30th September 2019. So first of all, let's charge depreciation on the new asset. The cost of this asset is 2500. We will write this in column B. Now in order to calculate depreciation on this asset, we will multiply the cost with the percentage rate, and then we will multiply it with the number of months as well, right? So from May till September, how many months are there? 5 months. Divide by 12 months. This means that my depreciation is 312.5. Let's make it 313. But in this year we have the previous asset as well, that is machinery A is also here, right? So let's calculate depreciation on this asset as well, and then we'll calculate the net book value for both of these in the end. So now again, should I charge depreciation on the cost? No, this time on the net book value, that was 1860. So 1860 multiplied by 30%. Should I multiply it with months as well? No, because in the next year, that is year number 2, this asset was present in the premises for full 12 months. So full year depreciation will now be charged on this asset, but on its net book value. So the depreciation would be 558, right? Now let's calculate the net book values for both of these assets, and that would be 1302 for machinery A and 2187 for machinery B. Now let's move to the next year, and that would be year 2020, right? Now are we purchasing any asset in the next year? Yes, we are. We are purchasing an asset which is on the first date of the third year, 1st October 2019. This means that its year end will be for 30th September 2020, right? So new asset is being purchased on the first date of the new financial year, right? Now, and the last asset was being purchased on 1st of April 2021. So this will definitely fall in the next year, not in the current year, right? So let's first charge depreciation on the new asset, that is machinery C, which is being bought at a price of 3200. So the cost is 3200 in the third column, that is for machinery C. Now depreciation would be again on the cost in the first year, 3200 multiplied by 30%. Should I multiply it with the number of months? No, right? Because why? This is being purchased on the first date of the financial year. So this means that it will remain in my business for full 12 months. So now I don't have to prorate it according to the months, right? So in the first year this was present for full 12 months, so there will be no proration according to the months. Rather 30% will be directly multiplied with the cost. That makes it a depreciation of 960, right? Now let's calculate depreciation for machinery A and machinery B as well. Now again the depreciation charge on machinery A will be on its net book value. So 1302 multiplied by 30% will give a value of 390.6. let's make it 391. And for machinery B on the net book value again, so 2187 for full year, right? This is present for full 12 months in the third year, so multiplied by 30%, 656, right? Now let's calculate the net book values for all these three assets, machinery A, B and C. So 911 for machinery A, 1531 for B and 2240 for machinery C. Right. Now let's move to the next year, that would be year 2021. This means that the year ended 30th September 2021. So are we purchasing any new asset in this year? We are purchasing, yes we are, on 1st of April 2021. So this means that it is present in the business from April till September 2021, right? This was the last machinery which was for machinery C was present from October till September. That made it for 12 months. Now this is being purchased on 1st of April. So April, May, June, July, August, September, right? So for how many months? 6 months. So we'll be charging depreciation for the next 6 months only and not for the first 6 months. So the cost of machinery D is 3600 in the last column, right, for machinery D. Now the depreciation charge on this machinery D would be cost multiplied by the rate and multiply it with the months, 6 divided by 12 months for half year only. So the depreciation would be 540, right? Now the depreciation for A, B and C as well we have to calculate. So for A, the net book value was 911, multiply it with 30% would give a depreciation of 273, right? For machinery B, 1531 multiplied with 30% for full year, and that would give us a value of 459. And for machinery C, the net book value was 2240. Now we'll be charging depreciation for full 12 months. This means that the value would be 672, right? Machinery A in this column, machinery B in this second column, for machinery C in the third column, and for machinery D in the last column. Now let's calculate the net book values for each of these machineries, right? So for machinery A, 638, for B 1072, for C 1568, and for last 3060, right? But what was the requirement? The requirement was to calculate depreciation charge, the depreciation expense for the year ended 30th September 2021. So now the depreciation expense that will be shown in the income statement, right, would be for all of these machineries, and that would be 273, 459, 672 and 540. So 273 plus 459 plus 672 plus 540, right. Bear in mind that the depreciation, I am adding these 4 depreciations, right, because all of these assets belong to the same class of assets, that is machinery. If there is a different asset, that is fixtures and fittings, plant and equipment, computers, so then for that we will be showing the depreciation expenses separately, right. We won't be adding that in the depreciation expense for machinery. So the accumulated depreciation would be 1944 for the year ended 30th September 2021, right. That's it for this video. See you in the next one.